Okay. All right. So last time, let me go back to where we were. Last time we ended on example 4, which was the issuance of stock at a price above par value. And this is, if you recall, we went through the question. I'll just kind of refresh all our memories, and then we'll do example 5 just to get us going again. But we said that Wright Inc. had issued 150,000 $1 par value shares of common stock at a price of $3.50 each. That's the issue price, which is the selling price. So a $1 par value, we already know that par value is kind of an arbitrary amount that the company assigns to the stock. This is, a legacy issue from back in the day when company law required companies to have a par value so that creditors were protected to some extent, that if a company was maybe not doing so well, they couldn't just, before declaring bankruptcy or something, just have like a dividend to their shareholders that kind of empties out all their money. And then when they do declare bankruptcy, the shareholders, I mean, not the shareholders, excuse me, the creditors don't get anything. But as time has progressed, the par value has become kind of less relevant, and companies will still sometimes put a par value. You saw, I showed you that Amazon has a 1 penny par value, but sometimes there's also no par value. So, when we are looking at these questions, you'll see in the next section, we're actually going to deal with no par value. So just so you know, a company could have par value, no par value, or no par value with a stated value. Those were the 3 scenarios of the types of stocks that a company can issue. There will always be an issue price. In the first example that we did regarding issuing stock, the issue price and the par value were the same. That's highly unusual. When you look at companies doing initial public offerings these days, they normally try to go for like the highest possible issue price. So, the par value is such a small number that it's highly unlikely that the issue price and the par value will be the same. But I did this example so that you could see what the journal entry looks like before we deal with anything to do with paid-in capital in excess of par. So on this one over here, we had said, just to refresh our memories, that cash is always the issue price. So this the price at which the stocks are being sold times the number of shares, right? So in this case, it was $3.50 times 150,000 shares. That's the rule around cash for a stock issuance. Common stock, on the other hand, is always going to be the par value times the number of shares. And if there's no par value, but there's a stated value, then it will be the stated value times the number of shares. So in this case, the par value was $1. So it's $1 times 150,000 shares. So we then said that, yes, we could see that debits and credits are not equal, and we still needed $375,000 on the credit side, and we lent this new account name, right? The paid in capital in excess of par value on common stock. The reason we write common stock at the end of the name is that sometimes companies have more than one type of stock. They might have common stock and preferred stock, and we have to differentiate between the paid in capital in excess of par value for common stock and the same account but for preferred stock, because we can't mix them together. There are 2 different types of shareholders, and so they have 2 different types of claims on the company. All right, so that's this very long account name. You'll also see it in the textbook, and that's what you will use for any excess above the par value. And then we went through and posted our journal entries to the ledger, and we said that if we credit something in the journal, we credit it in the ledger. And you'll find this again when you're looking at the homework for this chapter, that when you're being asked to post to the ledger, most of the accounts, I think if not all the accounts that you have to use, are capital accounts. So all of them are going to increase on the credit side. All right, the debit side is really not used that much for these types of transactions, because we're basically increasing the owner's capital to show that they invested in the company. It's just different account names that we use from before when we used owners capital and partners capital. So 150,000 credit, yeah, copy paste here, 375,000 on the credit side. The only thing that's being debited is cash, and that's just following again the journal entry. Let me see, someone's trying to tell me something. Oh, thank you for your well wishes on my health. Thank you. I love tea. It's probably a holdover because I'm from South Africa and we were colonized by the British. So I love drinking tea, and I am also drinking all kinds of tinctures and taking all kinds of. I'm like big on, if I'm not feeling well, I basically take anything so that I can feel better, because I hate feeling like this, and also because my job involves a lot of talking, so my throat needs to be in order. So thank you for wishing me well. It's the first time that I've had a cold since the pandemic started, because basically we didn't go anywhere. So I almost feel like I don't remember what it's like to have a cold. And again, like I said, I don't think I have COVID, but we'll all be tested this afternoon or tomorrow, to make sure that, not that I can contaminate anybody through the screen, right? So that's good. But just in case you're concerned for my well-being, please don't worry, we'll be okay. Yeah. um, and hopefully everybody else is staying safe and healthy as well. Yes. Thank you for the honey. The honey will coat my throat. All right. So what's next now? Let's do the next example, but I'm going to switch it up a little bit. I'm going to ask you guys to do the first part. Not, you don't have to do the T accounts if you're not feeling comfortable, but I am going to ask you to do the journal entry. So I'll read it with you, and then I'll give you a few minutes to do it. It says, on December the 17th, 2018, Beltran Inc. issues, here's the number of shares, 750,000 shares of $1.50 par value, shares of common stock at an issue price, so that's the sales price of $4 each. Prepare the journal entry required for the issue of the shares. Prepare the relevant T accounts. So let's say I'm gonna give you, we can go until 10:50. Let's just have you, whoever doesn't have access or isn't logged into this document or hasn't downloaded it, just take a picture of this, because I'm going to put the screen back onto the previous solution so that you can see how the journal entry runs, right? So try to do part A. I think I will actually include the T accounts, try to do the T accounts as well. Okay, so take a picture or get the document out wherever you have it. All right. And you have until 10:50 to follow basically the same approach as what was here. Okay, I'm going to leave this up as much as possible. So you're doing example 5 until 10:50. Then someone, when you're done, somebody raise your hand to tell me that you want to tell us the answer. Okay. Example 5, everybody. Okay, see, as soon as we reach 10:50, I'll take you for the answer, okay? Right, see, you wanted, just give me a second to set myself up. And then you can take us through what you have down for the solution. Just 1 second, I want to see where I put the debit. Okay, that's right. Where I put the debit. Okay. All right, go ahead.
So you debit cash for 750,000.
Okay, so debit cash, are you talking about, just 750,000? Is that it?
750,000, yeah.
Don't we
No,
multiply it or
you still have to
we
multiply it
multiply-
by the issue
Sorry,
price.
yes, 750 by 4.
Thank
Sorry.
you to all the friends who supported there. So 750 times 4, there we go.
Yes,
right?
so it's 300. No,
Okay.
3
3
million.
million.
3
Mhm.
million. And then the common stock.
Sorry, just hang on. I'm was trying to work faster than I should and not doing a good job. So common stock is going to be the par value times the number of shares, right? So the
Mhm.
shares is the same, 750,000 shares times, tell me,
1.5.
1.5. Yeah,
And then you credit 1,125,000.
yes. And then what's happening after that?
And then you credit paid in capital in excess of par value common stock. You credit it for the rest, so it's 1,875,000.
Yeah, so we can just subtract. So it's a plug number, 1,875,000. Correct. So that's the issuing of the common stock. So hopefully people see now, and I'll be with you in a second. See, hopefully people see now that the quote unquote formula or rule of how to populate cash and how to populate common stock is the same as example 4, and it's the same really across the board. It's the number of shares times the issue price. It's the number of shares times the par value. And then the excess is always just subtracting whatever you receive for cash minus what you credited to common stock. Did you do the T account? See?
The T account?
Yeah, did you do it? If you did it,
No, but I can
that's-
do it.
yeah, okay, so let's do it together. So it's gonna, it's gonna be common stock here. We know that it's a capital account, so it's, oops, sorry. So it's gonna go up on the credit side.
Mhm.
So we don't have a balance of any kind, so we're just gonna put in, right, the 1,125. So copy paste, right? 1,125, 123. And there's nothing else to add. I mean, you can put in the dates and stuff. When you guys do this in Wiley, it will have you put in the date and so on. I'm not gonna get too fancy here. I just want to make sure that people remember that it goes on the credit side. And that's the balance. Do you agree? See?
Yes.
So you walk me through the paid in capital. Oh, sorry. You walk me through the
So
paid in
same,
capital.
yeah,
Mhm.
same thing, paid in capital in excess par value, and then you do credit of 1,875,000, and then the balance will be the same.
I'm getting a little bit tired of writing out this whole thing, so I'll do it. When you are doing this in Wiley, the names will already be there. Okay, so thank you. So it's the 1,875 that we get from there, and then we're just gonna balance it out. And again, people might say, well, do we even need to do a balance? I'm trying to just show you how this would work, even though there's not more than one number in here. And then the last one, C, is the cash accounts, right?
Yes, cash you debit for the 3 million,
Mhm.
and then the balance is 3 million also.
Mhm. Cash is an asset. It went up on the debit side. Whatever you do in the journal, you do in the ledger. So you're going to take the 3 million debit and copy paste onto the debit side of the ledger. And then you are also going to put the balance of 3 million and you're done.
Mhm.
And now we come to the B part, right? In the B part, they're asking, thank you, Sia, much
problem.
obliged. In the B part, they say, and this I'll do because there's a whole lot of headings and subheadings and things that we have to go through. Assuming that retained earnings is $750,000, so they're giving you the number for retained earnings, prepare the stockholders' equity section of the balance sheet. So again, we did a small stockholders equity section the other day, but this is getting a little bit more sophisticated because you've now have this paid in capital in excess of par, and you have to see how that fits onto the scene. Okay. And it's I'll build it. And then what I'll do afterwards is I'll show you in the textbook illustration 13.11 is a good example of how the balance sheet should look. The balance sheet for a lot of people, sorry. Okay. I'm noting the comment about Andrew. The balance sheet is sometimes for this chapter and in general for people a little bit tricky because there's a lot of like headings and subheadings and things to remember. For the most part, when you do the homework in Wiley, they have a lot of the things pre-populated already, but you would do well to sit with the textbook or refer to the textbook to just make sure that you're using the correct headings. There's especially one question that asks you to just do the paid in capital section of the balance sheet. So the first heading is paid in capital as opposed to stockholders equity. And that always trips people up. I don't necessarily think that the way they wrote that question is I think it's a little bit frustrating, but that's how they chose to write it. I'm just warning you that there are balance sheet stockholders equity sections in the homework for chapter 13, and that you need to kind of find the rhythm of how this runs. If you were working in practice as an accountant or for a firm or whatever, you would have the previous year's financial statements to look at to see, how everything is written out. So you don't have to memorize these things necessarily. I'm more concerned with you being able to account for the transactions, but you do at least need to understand why the balance sheet is set up the way it is, and I'll explain that now. So this is the B part of the balance sheet. So as with any financial statement, we put the name of the company, we put the name of the financial statement, and the book tends to put partial when you're doing when they're doing just a piece of the balance sheet. So I'll follow the same approach. And then you can put liabilities and stockholders equity as the main heading for where this goes, or I think sometimes the book just goes straight into stockholders equity. That's also fine. I'll just put this here so that you guys can remember that liabilities and stockholders equity is the main section. Now we have stockholders equity as a subheading. And then you may recall from the notes, and let me see, I thought I had opened the notes. Sorry, let me just see what I'm doing here. Okay. You recall, or you may not recall, which is fine, from the notes that that a company has two types of where am I? Sorry. That a company has two types of corporate capital. There's the paid in capital, which is being paid in by the shareholders into the company, so from the outside in. And then you've got retained earnings, which is what is earned by the company. Remember, we went through this whole discussion about retained earnings being the net income from all the years that the company has been in business that they have not yet paid out as dividends. And you might recall that we looked at Amazon's financials and they had like $52 billion in retained earnings. So the distinction here in the balance sheet is also going to be between the paid in capital that came from outside so that a user can see what was paid by the by the stockholders and then what was earned by the company. All right, so that's why the next heading is going to be paid in capital. All right, telling people this is coming from outside. Then we've got another heading. I know this is getting a little bit crazy, but this is now capital stock. So it's just trying to say what types of stock does this company have that was paid, that the investors bought. And we're going to say now that it is common stock. So already you're probably happy that you don't have to memorize all the stuff because we just had 3 headings, right? Headings and subheadings before we even come to a number that we have to populate. So all we do, because you know the counting cycle, this might be like old news to some people, and some people may not remember. From like if you think back to accounting 1, and it's kind of it comes together in chapter 4. The counting cycle is, you know, you have the transactions that you then journalize, and then you post them to the ledger, and then you prepare a trial balance, and after the trial balance you prepare the financial statements. So the ending balance on the ledger is always going to be what goes to the trial balance, and that's also what goes into the financial statements. It's always the ending balance, not some intervening. So if there were 2 numbers here and they were added together, we would take the final number. So in this case, it's 1,125,000, and that's what we put in as our common stock balance over here, right? And it's possible that companies can have more than one type of stock. You saw when we were looking at the Amazon financials on Tuesday that they had preferred stock, even though they haven't issued any preferred stock, they may have had preferred stock. So if they had preferred stock, it would also go into the section, and the preferred stock would always be listed first. And so we don't have any other types of stock, but I'll still do the subtotal just so that you can see how it looks. So you say total capital stock. I know this can be overwhelming. You're like, how on earth am I supposed to remember all this stuff? If we were in person, if our class was in person, I'd actually give you a template where, you know, maybe I'll ask you to remember to fill out 1 or 2 things, but for the most part, it would be a template that already has the names, because my purpose, again, is not for you to sit and memorize things that you don't understand. The purpose is for you to be able to account for these transactions, right? And then the formatting and so on can always come afterwards. When you're doing the homework, if you get stuck on what the names should be, or if if Wiley asks you to populate something, I'll show you in a minute here where in the textbook you can go and look to see what these things are called. So we did the total capital stock. We still have not written in the paid in capital in excess of par value anyway. So that comes next. And that's the heading over there is additional paid in capital. That's what they call it. Additional paid in capital. And the first line is in excess of par. And that's for common stock. If they had been preferred stock, the preferred stock would be listed first, but we don't have any preferred stock. And now you take that 1,875,000 that you had from the ledger, the ending balance, and you put that in. And so now you have an opportunity to total. So now you say total paid in capital. This is telling a user that this is the total of the amounts that our stockholders have given to the company so far, right, from outside. So that's the total paid in capital. And then the next line is what we were given in the question. Remember, I'll come back to the answer in a second. Remember, the question told us that retained earnings is 750,000. We did not have to calculate that. Retained earnings is not paid in capital, it's earned capital, so it has its own separate line, 750,000. That's the end. We don't have anything else more in stockholders' equity. So then you say total stockholders' equity, and we will do, this, I don't have a double underline, but that's what we would normally do. And so you add these 2 together, and you would put the $sign for the ending number, and that's your stockholders' equity balance sheet. That's how you format the numbers that you've already come up with. Questions there? A little bit involved, so if anybody needs me to explain something over, I can. Okay, apparently we're all good on that. Oh, sorry, I didn't mean to do that. So let me show you where in the textbook, and getting to the textbook in Wiley is a little bit strange, but you just go to Wiley Course Resources, And yesterday there was a lot of problems with the e-textbook opening. I don't know exactly what was going on with Wiley, but in the textbook in chapter 13, so yeah, let me Rakathon is trying to sell me something. So yeah, illustration 13.11 is showing a full, that's what I was saying, right? That you do find this in the book. It's showing a full stockholders equity. So you can go and look at that shortly. Just bear with me for a minute as you look at this. I just need to blow my nose. So just to go over this, because it might also look a little bit daunting even as you look at it. It's kind of the same what we were doing before: stockholders equity, paid in capital, capital stock. Now here they actually explain what types of shares the company has outstanding and authorized and so on. We're not going to that extent, especially because when you do these questions in Wiley, they don't actually ask for you to populate this information. But you can see that the preferred stock is listed first, then comes the common stock, right? So preferred is always first. There's the total capital stock. Let me just go back to what we were doing for a second. See, it's the same thing: stockholders equity, paid in capital, capital stock. We don't have preferred stock in this example, so we go to common stock, right? And then when we total it, total capital stock. We're basically mirroring what what a balance sheet would look like. Then you've got this additional paid in capital heading. If you go back to our answer there, you've got additional, sorry, I didn't realize I made a typo here. Additional paid in capital in excess of par for common stock. There's your number to give you total paid in capital. If you go to the book, you see, additional paid in capital in excess of, well, yeah, they have a stated value. It's just the way the question went, but in excess of par, that's for their preferred stock. And then you've got a total paid in capital. Then you've got your retained earnings, which we just did. So we haven't reached treasury stock yet. By the end of today, we would have probably gotten there. So you don't know yet what this means, but if you use this example for to guide you. If there's no treasury stock, then this balance would just be total stockholders equity. All right. So besides this example, there are many other places in the book. You just go back up. I don't know if I should say many, but there are a few other places in the book where you'll see, right, the balance sheet being shown, how to build it. And the reason I'm kind of harping on about it is that I often find that people struggle to know what is what in the balance sheet. And I just want to reiterate that a lot of the hard work is done up here in the journal, where you actually have to figure out how to account for this transaction. The ledger is really just a copy paste, and the balance sheet is just disclosing or showing the numbers in a particular order. And many of these names and headings and subheadings are already given to you when you do these questions in Wiley. The bigger issue in Wiley is going to be that you get the amounts correct, which is really the point of accounting as well. Yes, the financial statements are a form of communication, but I mean, we can always refer to something to give us the format, but if the numbers are wrong, that's a much bigger problem than trying to get these words right, which we can figure out fairly easily by looking at the previous year's balance sheet. All right, so that was the B part over here of example 5. And now we've actually reached the end of issuing par value stock, remember I told you there's three things: issuing stock at par value, issuing stock at no par value, and issuing stock at no par value with a stated value. All right, so we've done one of them. So we'll move on to the next one. And so let me just go down here and see if there's anything that I want to reiterate. I've kind of already said this to you when we went through the questions, but in the notes I also wrote, right, the issuance of stock affects only paid in capital accounts. It can't affect retained earnings. You can't create profits by issuing stock. You only create profits by conducting the business that you are in. When accounting for the issuance of a common stock, or sorry, not just of common stock, I guess, and preferred stock, but in this case, we're just busy with common stock. You look at issue price, which we did, par value, and the number of shares. And then we've already kind of seen this play out in the journal entries, that cash will always be debited with the issue price times the number of shares. Common stock is the par or stated value times the number of shares. And then you've got this paid in capital in excess of par value, or paid in capital in excess of stated value. And that's just the plug number, the difference between what you put in cash and what you put in common stock. And now we're going to come to the no par journal entry, and that's going to be even simpler. Because there is no par value. So whatever you put in cash is going to be the same thing that you put in as a credit to common stock. Okay, so you can't split the credit between common stock and paid in capital in excess of par, because there is no par value, right? So it's going to be fairly simplistic. So going into the exercises, which I did end up pasting into this Google Doc. So anyone, accessing the Google Doc, you should be able to see these other two tabs. We're moving on to example 6, which is now the issuance of no par value common stock. So on July the 20th, 2018, Reyes Inc. issues 1 million. This is not dollars again, this is number of shares. 1 million no par value shares of common stock at an issue price of $5 each. Prepare the journal entry required for the issue of the shares. So again, based on the theory that we just read, the cash is going to be the issue price times the number of shares. Common stock is just going to be credited with whatever same amount you put into cash. So a very simple example. So I'm going to do it for you over here. Example 6. So cash, and it was, let me remind myself, it's 5 million. So it should be, yeah, 1 million times 5 million shares. So it's 1 million shares times $5 per share, right? Now, oops, sorry, that wasn't what I meant to do. $5 per share. So 5 million. And then the common stock will just have to take the same amount because there's no par value. So that's it. That's the issuance of stock with no par value. There's no paid in capital in excess of par, or paid in capital in excess of stated value. You can't do it because there's no par value to work with. So this is just no par value common stock. In case you want to write that down. Questions on that? Anybody?
Common stock is like the owner's equity, right? Owner's
Yeah.
capital. Oh, okay.
Yeah, part of the owner's capital. That's the part of the capital that the owner pays into the company. The other part of the capital is the retained earnings, which is the profits that the company makes that actually belongs to the owner but hasn't been distributed to the owner yet. All right, so 2 parts to the capital.
Okay.
All right. Other questions? All right. So then we look at the B part, which says, assuming that retained earnings is 660,000, prepare the stockholders' equity section of the balance sheet. So we're back in the same boat as before to prepare the stockholders' equity section of the balance sheet. So common stock is, and I'll just do it because the more you see me doing it, hopefully the more comfortable you'll get with it, and eventually we'll get to a point where I'll ask you to do it, but that we're not at that point yet. So Reyes Inc., right? Again, balance sheet, and it's a partial balance sheet. There should be a date of some sort. Did we get a date? I guess it's just on whatever date. So it was July the 20th, 2018. So I'm just gonna make it December. I will just assume that we're at the end of the year, nothing has changed. December 31. Okay. And then again, I'll just put liabilities and stockholders equity, but probably the Wiley won't ask you to do that. I'm just giving you the full heading so you see where this fits in. So then we're doing stockholders equity. And now we're just going to show again that it's paid in capital. Just bear with me. I have a runny nose today, so I have to just wipe my nose. Sorry about that. So paid in capital, and then it's going straight down the line, the same thing every time. Paid in capital, capital stock. We don't have preferred stock, so we're immediately going into common stock. You're going to put the 5 million that you just calculated as your common stock balance, right? And then you call this total capital stock. And again, I'm becoming like a stuck record, but just so people don't panic, a lot of these headings are given to you already in Wiley. Okay, I'm more concerned that you actually get the numbers right next to each heading. And then after that, you've got your retained earnings, which is the earned capital. The question told you that the retained earnings was 660,000. So that's the number that you put in there. And then obviously you just add these two together. So the total stockholders equity consisting of paid in capital and earned capital is 5,660,000. Any questions on the balance sheet?
Professor?
Yeah.
As far as like the balance sheet, always make sure it's in that exact order, right?
Yeah, it's got to go
Yeah.
in this, that's the one thing. It's kind of it's a very systematic approach where it has to be in this order. You can't really swap the order of things around, and it's for good reason. Like even the fact that preferred stock is listed usually before common stock is actually because the rights of the preferred stockholders supersede, they're above the rights of the common stockholders, so the balance sheet actually reflects that. So there's a reason for everything, and the common stock and preferred stock being first is because they're first showing what was paid in, then they're showing what was earned by these people, and then we're totaling everything. Okay.
Okay.
So definitely keep the order.
Okay.
Other questions? And again, I know I've said this, but I'll repeat. Do not make this into an exercise of memorization, just so you know what the names are, but you don't know where the amounts go, whatever, because more often than not, you'll get given a template and they're more concerned with you knowing how to do the numbers than the names. So I'm going to put you guys to work now to do example 7. The issuance of no par value shares at an issue price of 350 each. So go ahead, I'll give you until 11:23 or thereabouts, 5 minutes to do it. And then we'll have someone who hasn't spoken yet or given an answer yet, raise your hand at 11:23 to answer this, or whenever, to answer this question. Okay, Denisa, you are done, I'm assuming.
Professor, can you scroll back to the example of the example 6 solution?
Yeah, so anybody who still needs the question, just take down the facts or take a picture. Someone's asking me to go back to the solution of 6, all right? So I'm gonna go away from this page. Again, if you guys want to, do this class a bit easier, just get the papers for yourself. So you have the questions at least. This is what you want to see, right? I don't know who was talking, but Shafak, this is what you want to see?
Yeah.
Okay. All right, so it's 11:23. The first hand that went up was Denisa, so I'll take you, Scarlett. I see your hand. Maybe on the next, on another example, I can take you. So, Denisa, do you want to tell me what's going on here?
Okay, yes. Okay, so we're gonna have cash 150,000 times $3.50
So cash is the number of shares times the issue price.
issues.
And that comes up to?
525,000 debit.
And then?
There is a common stock. Since there's no par value, the common stock will be credited 525,000.
Yes, yes. And that's the journal entry. So a no par value situation is actually very easy. You basically just dump whatever you had in cash goes into common stock. You don't even have to think about par value. Thank you. Let's look, sorry, maybe I moved too fast. If someone still needs to take this down, if you haven't finished. All right. I'm assuming that this was simple enough that people should have taken this down by now. So here goes our last our last example under the no par value situation before we get onto a different topic. And in this example, we have a no par value stock, but it has a stated value of $1 each. So here's the secret or the trick, right? When there's a stated value, you treat the stated value as if it's par value. So whatever you would have done if it was par value, you do the same thing with a stated value. It's just that the name of the paid in capital in excess account becomes in excess of stated value instead of in excess of par value. So let me just remind you guys, when we were up here in example, gosh, did I not write the example number down? Example 5, sorry. Example 5, we had a par value and an issue price that was higher than par value, and then we had paid in capital in excess of par. So for this next example, it's just going to change to in excess of stated value, and everything else is basically going to be treated the same. The common stock will just be the number of shares times the stated value. This is actually also written in your notes, where I said that you will credit common stock with either the par value or the stated value times the number of shares, depending on whether the company has a par value or stated value. So example 8 is going to look very similar to what we've done before, but you have to be careful because it's just that one little account name difference, but it's actually an important difference. And people often have contacted me on, if there was a question with stated value, contacted me to say that, Wiley is marking this thing wrong, but it's right. And then it was just because the account they were using was saying par value instead of stated value. All right, so watch out for that. So on October the 12th, 2018, Wright Inc. issues 150,000. Notice how it's almost the same question, right? 150,000 no par value shares of common stock with a stated value. Here, there's no stated value. With a stated value of $1 each at an issue price of $3.50 each. Prepare the journal entry required for the issuance of the shares. And then you've basically got almost a carbon copy, right, of this question. Prepare, that was over here, to prepare a stockholders equity section of the balance sheet, with the retained earnings being 660,000. So let's do the journal entry and then we'll take a break and then we'll come back and look at the balance sheet. So we follow, the usual, what we've done before. The cash is going to be the number of shares, right? Number of shares times the issue price. That's what we follow. And if you go back to the question, 150,000 times $3.50. So 150,000 times 350. That's, oops, I missed something. 150,000. That's 525,000. Looks familiar because it should be the same as before. Then the common stock is going to be the number of shares times the stated value, right? Because there's a stated value here. We have to follow that as if it's par value. So the stated value is $1 and it's 150,000 shares. So it's going to be 150,000 times 1. Did I do that again? What is with my finger there? So it's 150,000. No surprises there. And now you come to the fact that obviously there is some type of difference here. 375,000 left over on the credit side. We know that that is additional capital that was paid in. So it's going to be called paid in capital in excess of, not par, but you don't have to capitalize it normally. I'm writing it so that you can notice that there's a difference, okay? Excess of stated value for the common stock. And literally this the word stated over here is the only difference between this journal entry and we've had a similar journal entry before, right? And the fact that you are also using the stated value in the common stock and treating it as a par value, but you're ending up basically with the same type of journal entry as if you had par value. Now, don't ask me why companies do no par value with a stated value. It ends up in the same place. It's again just something that seems to be done. I haven't found a satisfactory answer for me as to why this really makes that much sense. I can only think that if you remember, par value was done in the past as like a legal thing to protect creditors. So maybe they don't want to call it par value because they don't want to have to keep that amount of money in reserve. And if they say no par value, but there's a stated value, they can still have something that looks like par value, but they don't have to be concerned that that money can never be distributed. I don't know. That's my theorizing. Do you care? Probably not. Do you need to know how to do the journal entry? Absolutely, you do. Okay, so know how to do the numbers, know when the name changes from par to stated value. And I guess the logic of why companies are doing this is a little bit mysterious, but I think it's got to do with the fact that there are more rules that surround a balance as a par value as opposed to a stated value. So it's more like the legalities around the situation are the issue. Okay, so it's 11:31. Let's take a break until 11:41. I'll stick around for the break if people have questions for me or something that you want me to show, on the screen that you didn't catch in time. But have 10 minutes, stretch your legs, do what you got to do. In that time, I'm also going to make sure that I have people's, well, when we come back, I'll make sure that I have everybody's attendance as well. Yeah. Okay. So at the risk of being repetitive now, we'll do the balance sheet one more time, just so people can really, reinforce what's happening with the balance sheet and hopefully ask me any questions. Remember, this balance sheet above here was when it was no par value, and the one before that was with par value. So this is going to be no par value with a stated value. And again, the only thing that changes is the name of that account, paid in capital in excess of stated value. So we've got Right Inc. is the name of the company. So I'll put the name of the company. You put balance sheets, right? Partial. Then you've got, let's just put a date, December 31, 2018. And again, you can probably guess already what's coming next: liabilities and stockholders equity. Right. Now we've got stockholders equity. Now to reiterate, we show first the paid in capital that the owners paid in from outside. Capital stock is the type of paid in capital here, which is common stock and preferred stock. The common stock number is coming straight from here. We're taking it off there. Under normal circumstances, you would have posted to the ledger, you would prepare a trial balance, and you'll take the number from the trial balance, but that's okay. We know that the number is 150,000. There's no other capital stock. In other words, there's no preferred stock. So this is going to be the total number for capital stock. And capital stock is differentiated from additional paid in capital. Okay, that's why this word capital stock is coming up, because now you're going to say, what's the additional, right? This is in excess of what was paid in just under normal circumstances for the stated value. So additional paid in capital in excess of, and there's again, I know you don't have to capitalize this for your homework or anything, but I'm showing you that that's the only thing that's different from the question that we did this just not to, I mean, it's not the same numbers, but in example 5, we did balance sheet with a par value, and it's almost identical except for this notion that you're now going to use stated value. You pick up your 375 from your journal entry, right? Or you would have picked it up from your ledger or from your trial balance. And then, Denise, a question?
Okay, so I have a question. Yes.
Hmm.
So on the Wiley homework, right? Even though we're just only put in the numbers that, for example, like the common stock, total capital, and the in excess stated value, right? The other how should I say it? The other, like for example, stockholders equity, that will be blank. So
Let
it will
me-
still be
Mhm.
correct.
Well, it depends on what if there's a blank, let's go in, like, let's actually not theorize, and let's see if we can go into one of these questions and see what's happening. Will that be helpful? Because I want
Yeah.
to make sure that I'm answering what you're actually asking. If something is blank in Wiley, then you need to put it in, like if they're expecting you to give the answer. I don't know if I'm understanding your question correctly.
So like for example, we're gonna on the balance sheet, we're gonna put all the steps that we've completed today, right? But what I'm saying is, you see like how we have the stockholders equity, paid in capital, capital stock, common stock, that's blank, it doesn't have any numbers. It will still be
So,
correct, right?
yeah, so they'll give you, they'll give you
Oh,
a
okay, I
drop
see it now.
down.
Got it.
They'll give
Okay,
you a
so it's a
drop
drop down.
down, yeah, and
Okay.
you'll have to choose, they'll give you the names, but you'll have to choose what they are.
Okay, got it.
So
See it
you
now.
can sit with, this is what I was saying, like you can sit with that illustration 1311, or you can sit with the examples that I've done in class, and you can see, oh, okay, yeah, after common stock, it's total capital stock, blah, 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 right? So you can choose from the drop down what names you're supposed to put. And it's only where there's a drop down, I think, that you actually have to fill in something. Where there's no drop down, the name is already there, if I'm not mistaken. Okay.
Thank you. I was just confused at first of how it would look, so now
Yeah,
I
yeah,
got a
and I
clarity.
think
Thank you.
that's fair, and thank you for asking. And just for the rest of the people, in case you're wondering, this is also how the ledger looks. You see how I said everything is happening on the credit side. This is the final question in the homework. You're kind of working up to this question, okay? So don't panic when you see it. It's like, oh my word, like this is so huge. There's a whole lot of other things that are kind of warming you up to get to that point. All right. So again, if someone missed, Denise's question was basically what's our responsibility when we get into Wiley, of what we will have to punch in, what's there. They will have some things where you will have to choose what's the name that of or what's the line that has to go there. This is why I'm showing you and explaining to you also why these names are there. You don't have to you don't actually have to memorize anything, because you are allowed, especially when you're doing homework, you should be sitting with the textbook or with your notes or whatever and trying to figure things out. Okay, so you're not expected to remember this from, this in your mind somehow. So it's not possible. So total paid in capital is now going to be both your capital stock and your additional paid in capital, right? That's what you're adding up here. And so it's also important for you to follow what I'm adding up, because even that type of question that we were just discussing, there's totals and subtotals. You need to know which things are being added together. Otherwise, you could get stuck, on a wrong answer for something as simple as just the wrong math. So then the retained earnings was given in the question as being 660,000. If you go back, remember they told us that it was 660,000. So that's where I'm getting that from. So you also want to make sure when you're reading questions in the homework or in a test, sometimes there's information given to you in the question. So once you start answering the question, don't ignore, the question completely, because you may find that there's still bits of information that you need to answer the question fully. So then for total, you're adding your total paid in capital and your retained earnings, which is your earned capital, and your balance will be 1,185,000. Okay, so I think hopefully at this point, people have now seen a balance sheet being constructed, I think in 3 or more, for 3 or more times. And that really the main thing is to remember that you're showing the paid in capital first. There's definitely room for the stuff that's in excess of par or in excess of stated, and retained earnings is going to be shown last at this point, and then you total everything together to get to total stockholders equity. Right, so that's the story there. I'll leave it here for a minute so that anybody who's maybe working along by hand will just be able to finish up their writing. And then as soon as we're done with that, we're moving on to issuing stock, not for cash, but for services or non-cash assets. And feel free to ask any questions you may have while I leave this up for people to look at or to write down. So. While we wait, is John here today? John Cardenas? No. Jaden Castillo? Nope. Michaela today? Michaela Cruz? No, she's normally well. Niley, did I see you yet? I feel like I saw you. Niley Figueroa? Okay, I thought so. Okay. Jahome Liberato? Jahome? No. Okay. Yadira Ortega? No. And Shimon Rostand? No. Okay. Thank you. Cool. So we're moving on. We're talking about issuing stock for services or non-cash assets. So when we go through this piece of the work, I want you to think about what we were doing when we were doing the partnerships work, how sometimes the partnerships were contributing assets to the partnership, like they were, besides cash, I mean, like other non-cash assets, like equipment and accounts receivable and things like that. So in this case, it's kind of a similar situation where the company's issuing stock, but instead of receiving cash in return, they're receiving like a building or land or something of that nature. This could happen if the company has an investor who maybe has a particular asset that they want to contribute to the company, and so they'll give the investor an ownership stake in the company and take that asset to be used within the operations of the company. There are also other things that could happen with, as it relates to services. Sometimes when a company is just starting out, they're doing their organization, like they're setting up, they may use lawyers and accountants, and it's possible that they could actually pay the lawyers or the accountants, instead of paying them in cash, they could actually give them stock in the company. So, excuse me, that legal fee or that accounting fee is going to be an expense. Expenses go up on the debit side. So we would debit expense, some type of expense or some type of fee instead of debiting cash, but the credit would still go to common stock and to any paid in capital in excess of par values or stated value. All right. And with the building or the land, the debit does not go to cash, it goes to land or buildings, because the asset land or the asset buildings of the company is increasing on the debit side, and the credit would go again to common stock or to paid in capital in excess of par or stated value. So it's kind of the same approach like when we did the partnerships work, right? Where we debited office equipment and we credit partners capital. So this is possible, right? And now the question becomes, though, when you are when you're issuing stock, and especially if the stock has a par value and all of that, you know, at what amount does this transaction get recorded? So let's say we had, and we're just talking, we'll do a few examples here in a minute, but let's say we had legal fees of $20,000 and we're going to issue stock in order to pay for those legal fees. Then the whole transaction, the total of the transaction would be $20,000. That's fairly obvious, because the lawyers are probably giving you like an invoice or something, and you can see how much they're charging for their services. But where things become less obvious is where, you know, someone is giving you land or someone's giving you a building in exchange for stock, and I guess everybody has to agree, right, on how much that land or building is worth. If you think back to the partnership's work, remember we said that we record those assets at the fair market value, right, of on the day of when they are being contributed. So this is a similar approach here. The amount that will be recording the transaction at is also going to be fair market value, because I can't say that, oh, I'm giving a building to this company, but I paid, $10,000 for the building, in 1975. So it must mean that the transaction gets recorded at $10,000. That doesn't make sense, because if I bought that building in 1975 and now we're in 2021, the value of that building has probably increased over time. So I wouldn't want to only get a $10,000 stake in the company. I want to get a stake in the company that is similar to the market value of my building. Otherwise, why would I give you my building, right? I could just go and sell it to someone else. So we're looking at fair market value as being the amount that the transaction would be recorded at. But there's two things at play here. Sometimes the company is a public company, so their shares are actually actively traded on the stock exchange, which then means that you could use the fair market value of the shares that are being given, that are being issued to the investor as the amount to record the transaction at. So you have a choice, right? You either use the fair market value of what is being given up by the company, which is the shares, or the fair market value of what is being received by the company, which is the land or the services. Now you're going to say, well, which one should we choose, right? The rule is that you look at whichever can be determined more easily. So if I go, remember we did this the other day, if I go into my into Google, or I went into my trading app or whatever. I don't know why this thing is doing this now. And I look for the Amazon stock price. It dropped a little bit since Tuesday, but I can easily determine the fair market value of one share of Amazon stock. It's $3,293.92, right? Which means that if I'm Amazon and I have an investor that is, I'm issuing stocks, extra stocks now to someone in some type of public offering, and they're going to give me a building in return, it's very easy for me to see how much the stock is worth. So then we'll decide, right? Okay, we'll give you 100,000 shares or something, and that will kind of equate to the value of the building. But if I am a private company that doesn't have shares that are being actively traded on the stock exchange, then it's not as easy to say, oh, this is what the shares are worth. So we will probably have to have the building valued by some type of appraisal, and like a bank or someone will come out to say, okay, this is a building, it's in Queens, it's blah blah blah, so this is what the buildings around it are worth, etc., etc. And so in the end we come up with a fair market value, and the fair market value is defined as usually what you can sell something for in the open market. Okay, someone's having a Wi-Fi problem. Okay, so that's the rule around this. Okay, so when we have questions in this regard, you're looking for a fair value of either the asset or the service that the company is receiving, or a fair value of the stocks that the company is going to be giving up. So I'll do some. Does anybody have questions about this before I launch into doing an example? Anything that's unclear right now before we even move on? All right, there's nothing in the chat. We seem to be fine. Okay, so it's exercise 9 onwards that, if you printed out the stuff or you have it somewhere, it's from exercise 9 onwards that we're doing the issuing common stock for services or non-cash assets. So let's see what this holds for us. Example 9, on March the 15th, Jordan Corporation issues 4,000, that's the number of shares, right, of common stock. It's not a dollar amount. Remember I told you, and I'll just, get on a mini soapbox quickly and then get off. In this chapter, when you read the questions, there are going to be a lot of numbers and words, vocabulary, and things floating around. You need to make sure that you're reading the questions carefully, that you understand what each number means, and that's the only way you can actually journalize anything. So practice is makes perfect. That's why I do like so many different examples with you. But me doing an example on the screen is one thing. You sitting and doing some examples on your own is really when the stuff is going to be sticking, fully. Okay, so just know that when you look at these questions, there's a lot of numbers and words and things floating around. So it's 4,000 shares of common stock to attorneys. So obviously the lawyers in settlement of their bill of 20,000. So this is the example that I was giving before, right? That you use the attorneys to do some legal work for you. You don't pay them in cash. Instead, you give them some stocks in the company, 4,000 stocks to be specific. The shares have a par value of $1 each. Okay, so we know that this is a par value situation and we know how to account for that. At the time of the exchange, there's no established market price for the stock. So unlike what we could do with Amazon, where we just said, oops, okay, there's the market price, we've got it. They're saying there's no market price for the stock. So if you go back to the theory, you know that you either choose the market price of the stock or the market price of the service that you receive. Since there's no market price for the stock, you have to choose the market price of the service that you are receiving to record the transaction at. So specifically $20,000. So prepare the journal entry for the issuance of the shares. Okay, so I'll show you how to do this. You can probably guess already. So example 9, we've got a debit and credit. Try and get rid of this thing. All right. So it's not cash, right? That was the whole point. We're not issuing stocks for cash. So you're going to debit the expense, right? The attorney fee. This is an expense is going up, right? You don't have to put this whole thing over there. I'm just trying to explain to you why we're debiting attorney fees. The expense is going up because we're actually recording the expense. So no cash debit, attorney fees debit. We still credit common stock. And because we have a par value, it's still going to be the number of shares times the par value. And if we go back to the question, we know already, but I'll just show you again. The number of shares is 4,000. The par value is $1. So it's going to be 4,000 shares times $1 each, $4,000. It's clear that the debits and the credits don't match, right, from a dollar amount perspective. So we will have to still plug in an extra 16,000 on the credit side. Anybody want to take a guess? You can just shout out what you think this account is going to be, or you can put it in the chat. Any takers on what that account might be?
Paid
Oh.
in capital in excess of par value.
Yeah.
Common
Yep.
stock.
Paid in capital in excess of par value for the common stock. And so this is stock issued for services. Just so you remember. So now we've applied a lot of principles there, right? We said that when we do this type of transaction, we look at either the fair value of the stock or the fair value of the service. We use the fair value of the service because the stock doesn't have a fair value right now. And then also we still use the rule that common stock is going to be the number of shares times the par value. And then the remainder goes to the excess account. And remember what's happening here now is that in effect, the attorneys or the legal company has an ownership stake of 4,000 shares in the business. Okay, so bear with me. I'm just going to blow my nose. All right, so it's as simple as that, or as, I don't know if it's, I mean, it seems simple to me, but everything would seem simple to the professor, right? But any Opening it up. Any questions or comments about this one before we move on to the next one?
So that's it?
Yeah, yes, that's it.
Oh, I thought we just got started.
No, well, we'll do two more. There's one with land. There's actually two more with land, but I'm saying that that's it in terms of if the company issues a stock for services. I mean, how could this question change? The question could be that there's no par value, in which case the entire 20,000 would go to common stock, right? The question could also change and say that it's a stated value of $1, at which point just this account name will change to stated value. All right, so there's only so many ways the question can be asked, Shafak. So I think if you get this, you're in great shape. Okay? Okay. Let's look at number 10. All right. So example 10, I'm going to be so bold as to read it and then have you guys try to do it yourself. On January the 22nd, 2018, Hunt Inc. issued, there's the number of shares, 1,000 shares, $5 par value, right, or the shares of common stock in exchange for land worth 50,000. So the word worth is generally implying that that's the market value, right? Hunt Inc. stock is not actively traded. So if it's telling us that the stock is not actively traded, that then means that we don't have a market price for the stock. So if we think back to the theory, right, you record the transaction at either the market value of the shares, which we don't have, or the market value of, in this case, the land, which we do have. So there's your hint. Prepare the journal entry for the issuance of the shares. So I'll give you it's probably too much time, but I'll give you 5 minutes until 12:10. And then someone who hasn't spoken yet today can raise their hand and give us the answer to this question. Example 10 is what you're doing right now. Yes, Garland, I'll take you at 12:10. Thanks.
Professor, after today's class, are we able to answer all the homework for chapter 13? No.
No, you will be able to answer the bulk of it, but we will go into treasury stock today, but we may not finish that. And then there's a little bit of issuance of preferred stock, but honestly, the issuance of preferred stock is basically the same as issuing common stock, but the name of the account is just preferred stock. So, I mean, you can try to answer it. It's just that I would not have completely covered, every single bit of information.
So, but it's can I start doing the homework or?
Absolutely, yeah,
Yeah.
absolutely. You'll be able to do the bulk of the homework. It's just that I think some of the smaller questions might be about treasury stock. I mean, you can skip over it, depending on how far we get today. We might get through it. I don't know. I have to see how far we get.
It's a shorter chapter than the other ones, isn't it?
It's about the same. There's actually more going on in 13 than 12, so I don't know.
Well,
But you can definitely start and save whatever you do, and then as you have more information, you'll be able to finish. All right.
Okay, thank you.
Okay, no problem. Okay, Scarlett, you're on. Let me get to the sheet here and get myself situated so you can give us the answer. All right, go ahead.
Okay, debit, 50,000 land,
Yes. So you're choosing the land because that's what it's worth, because the stock doesn't have a market price, right?
and then common stocks.
Mhm.
I did 1,000 times $5, which is 5,000.
Yeah, so it's the number of shares. Sorry, hang on. Number of shares. Let me just go back here so everyone can make sure. Number of shares times the par value. All right, that's correct. So that's 5,000. And then you know that you still need
The paid capital,
45,000. Go ahead, paid in capital in excess, right, of par value on the common stock.
credit 45,000.
And you're done.
Yes.
Thank you. So now I'm going to read example 11 with you guys, and then you will do it. And then again, someone who hasn't spoken yet today can tell us what they think the answer is. And when we're done with 11, then this is the end of the practice for issuing common stock for services or non-cash assets. We could keep doing examples over and over, but it's going to be, we've seen the different scenarios by the time we do example 11. So Athletic Research Inc. is an existing publicly held corporation. So already you have a hint here. If it's a publicly held corporation, it means it's like your Amazon or your Google or whatever, that there's actually going to be a stock, a market price for the stock, right? It's $5 par value. So there's the par value for your, when you do the common stock journal entry, the $5 par value stock is actively traded at $8 per share. That means that there's a market price for the shares. The company issues 10,000 shares. There's your number of shares of stock to acquire land. So land is the asset that's being debited in this journal entry, recently advertised for sale at 90,000. Prepare the journal entry for the issuance of the shares. So here you have to decide, and don't shout out the answer, whatever, just do the journal entry. And like I said, someone who hasn't spoken yet will give us the answer. Yeah, you have to decide whether you should use the fair market value of the shares or the advertised price of the land to record as the amount at which the transaction should be recorded. So go ahead, I'll give you until 12:18 to work through this question, and then I'll take an answer from someone. We have 2 more minutes when we're ready. I'm gonna take Wen, who hasn't spoken yet today, Wen Chen, if you'll give us the answer. Okay. All right, Wen, are you ready for me?
Yes.
Okay, let me make sure that I'm ready for you. And I'm not. All right, here we go.
So for land, 80,000 will be debited.
So you are correct, but can you tell us your thinking around why you chose the 80,000 and not the 90,000?
To be honest, I just kind of guessed at it.
Okay, that's guessing is welcomed, and so we can chat about it more. You're right, because I think what you, I'll just put ideas in your head, okay? So I think what you were looking at was that the company's stock is actively traded, right?
Yes.
At $8, which means this is a very reliable number that you can use as the, as what the transaction is worth. And you said, okay, if the company is giving up 10,000 shares that's traded at $8, the person who is giving them the land can literally take those 10,000 shares and immediately turn around and sell it for $8, right, on the open market. And the land would in essence be worth 80,000. So that's what the company should record the land at. You may have also considered this notion that there's an advertised amount of 90,000, but then advertised is a very, it's a misleading situation, because look over here, the land was worth 50,000, right? Whereas here it's only advertised for 90,000. Something being advertised for a particular amount doesn't mean that that's what it's actually worth. In fact, we've seen that a lot with the housing market. Even now, in this time of COVID, houses have been marked at very expensive amounts, but that's not actually what they're worth when the bank comes in to appraise them. So you're right, it's 80,000 because the rules tell us that we are going to go either with the shares, if there's a fair market value for that, or the land, whichever can be determined more clearly. The share price can be more clearly determined. So we can't go with what something was advertised for. We have to go with the actual price. So for anybody who chose the 90,000, it's only an advertised amount. That's not an actual fair market value. That's just what someone would like to get for it. Whereas they can get $8 per share for 10,000 shares. So we use the 80,000 for the land amount. Thank you. Continue.
And for common stock and pay in capital, it would be 50,000 and 30,000 in credit.
Mm-hmm. So it's 10,000 shares. It was a $5 par, right?
Yes.
Yeah, so it's 50,000 for the common stock, and then as usual, the excess is the plug number to balance the dollar amount of debits and credits, and you're saying this is paid in capital in excess of par value on the common stock, 30,000, all right? And again, to repeat, we don't use the 90,000 for the land because the more reliable number is the $8 market value of the stock. $8 times 10,000 shares is where the 80,000 is coming from. Thank you. When anybody have questions on this one, or you want to debate a little bit more than 90,000, or you just want to chat about anything to do with this question?
I had just chosen 90,000, but as you said, if it's advertised, then you shouldn't use that specific number because that's not the actual amount that it's worth. So whenever we see a question that says advertised, you just go with,
Yeah, you tried
um,
to go. Sorry, go ahead. I didn't mean to cut you.
no, it's okay. You
Yeah,
just
you
base,
go with what is more reliable.
okay,
So
okay.
like, yeah, so like going on Zillow, for instance, and looking at an apartment and it says, 250,000 or whatever, that may or may not be the value of the apartment. It's only when an appraisal gets made that you actually see what it's worth. So if I was getting, Amazon stock in exchange for that apartment, I would go with the price of the stock because I can literally go onto the internet and see the price immediately. It's also easier to determine the price of the stock than it is to get a bank to come out and do an appraisal of the building.
Got it. Thank
Other people want to ask anything? All right. So there may be questions like, I think there are questions like this in the homework. So please, remember this or access this Google Doc when you need to, or do whatever you got to do to make your life easier. Okay. Right. So we don't have much time left over. I've already shown you the balance sheet many times. So this is just talking about how the balance sheet consists of paid in capital and retained earnings. And then it says, let's prepare a basic stockholders equity section, but we've already done that probably about 3 times. So we're ahead of where we need to be. So I'll talk a little bit about treasury stock before we call it a day here, and maybe do 1 or 2 journal entries around this. Treasury stock is a specific class of stock, right, that the company has on its balance sheet, and it relates to the company's own stock that was previously issued, and then the company bought it back from shareholders. Okay, so imagine that you have shares in Netflix, and let's say you have 10 shares in Netflix, and then Netflix does a share buyback, and maybe they buy back 1/10 of their shares. So then after the buyback, if you participate in the buyback, you'll have 9 shares of Netflix, and you will also have the dollar amount, because Netflix would have to pay you, right? Let's see what Netflix stock is at right now. I can't remember. Sorry. I should have said Netflix stock. We don't want to start watching. Okay, so it's at $610 a share. So the company gives the shareholder the current market price of the share, $610, and then the company actually takes the shares back. As weird as that sounds, but this could be done. They're back, but they called it not retired, which means at any time in the future the company could issue those shares again if they want to. They do it for a number of reasons. In recent years, there's actually been a trend towards this, and it's a little bit frustrating if you look at why companies are doing it, and the frustration is, in my opinion, okay, it's frustrating. I'll give you an example of why it's frustrating. Before COVID hit, a lot of the airlines had so much cash on hand, they were so cash flush that they were just entering into all these share buybacks because they basically didn't know what to do with all the cash that they had on hand, right? Interest rates were pretty low. We couldn't really earn much interest on the cash. What the share buyback does is it almost immediately pushes up the price of the stock because suddenly someone's coming in and making all this demand on the stock, so the price goes up, right? I mean, this is basic demand supply economics, so the price goes up. And so companies, I mean, I don't want to say that they're artificially inflating their stock price because it's, I mean, they're engaged in a transaction, but the outcome of that is that the stock price goes up. Everybody looks good. If some of the board of directors and other members of the company also have shares, or they have stock options, those things are immediately worth more than what they were before. So in a way, they're creating value for themselves. And then what happened? COVID hit. And no one wanted to fly. I mean, except for some people that were not as risk averse, but there were not many of those. Nobody was flying. The airline suddenly ended up in a situation where they didn't have enough money to operate or to like pay their payroll and so on. And who did they go to for a bailout? Where did they get money from? Do you know?
Government?
From the government, right? The good old government that, a lot of the times people are like, oh, we don't want big government. The government is doing too much. They're giving out money or whatever. But when it comes to, and listen, I'm a business major, like I understand capitalism and everything, but this is an ethics question, right? It's a little bit ethical because it's like, okay, so you used up all your cash and you didn't keep enough cash in reserves. We as finance people tell individuals to keep like 6 months worth of your expenses in an emergency account so that if you lose your job, you will still be able to pay all your bills for at least 6 months, which is maybe how long it might take you to get another job. Whereas the airlines could barely function for a month or two before they were running out of money. They got the money from the government. So they used up, maybe erroneously used up their money to buy back stocks. So that's one example where you kind of, they're cash flush. They want to push up the stock price in a way. And they decide that a good idea is to buy back stocks. And since there's fewer stocks out there, the price goes up, everybody runs to the bank happy. So that's kind of like the cynical reason why this might happen. Then there are other reasons, like this is more like from back in the day in the 80s, when some of you wouldn't even have been born yet, where companies were having like these hostile takeovers and stuff where, someone comes in and starts buying up the shares of a company and they try to get to like just over 50% of the shares, because if they do that, then they are the majority owner of the company's shares. So then they can basically tell the company what to do. So if a company is trying to prevent a hostile takeover, they might start buying back their own shares so that they have those shares in the treasury, and whatever bad actor is coming through to try and do this hostile takeover will then be prohibited or prevented from getting to 50% plus of the shares. So they're trying to basically protect the company. And I mean, there could be other reasons, but they're not that many, other than maybe trying to prevent the takeover or just trying to prop up the stock price because they have cash in excess. So again, what is happening? Oh, sorry, Shafak, go ahead.
So, the owners who decide to take back the stocks, are they gonna have an agreement with it, or they just take it without?
No, there's an agreement. So if I own, let's say I own this 1 or 10 Netflix shares, right? So my ownership in Netflix 10 times 610, so it's worth 6,100. If they come and buy a share from me, buy it back, I have to agree to it and they have to give me $610.
Okay.
They're paying out cash. This is not like this is not a share grab, where it's like,
Okay.
we're just
I
coming
thought
to.
I thought
No.
they'd be like, it's our stock, we don't
No.
ask.
No, you'll see when we do the journal entry also that the company records treasury stock as the debit and they credit cash because they're actually paying out cash to the stockholder that they are that they're buying the shares back from. So thank you for asking that question. I didn't mean to create a scenario, very like Netflix-esque scenario where the company just comes through and starts grabbing back its shares and people are running around angry in the streets. Nothing as dramatic as that. If only accounting was so dramatic, it's not. So there's multiple reasons, more reasons that you can read up if you want to in the book why they would buy it back. But for the most part, it's got something to do with like trying to prop up the share price. So how do we account for that? Because remember, we're sitting in the company, we're the accountants of the company. We need to know how to record this transaction. All right. So companies account for the purchase of treasury stock, right? Buying its own stock back using the cost method. And when we say cost method, we're basically saying the transaction is recorded at the amount, the cost of the stock, right, that the company bought at whatever date. Doesn't matter what the par value of the stock was, doesn't matter, once upon a time we issued the stock for $3 and now it's at $600. So shouldn't we record it at $3? No, you're looking at what you are paying today to buy those shares back. And here goes the journal entry. The company will debit treasury stock for the price that they paid for the stock, and they will credit cash. Crediting cash decreases the asset cash because they are paying out cash to whomever they are buying the stock back from. So now you should be thinking, so what type of account is treasury stock? Because we're debiting treasury stock, right? Maybe you're even thinking that it could be an asset because it looks like it's going up on the debit side. But yeah, I'll explain to you in the notes here. Treasury stock is so here's a nice little, tidbit for us. It is a contra stockholders equity account. So maybe, and we spoke about this, I think when we spoke about allowance for doubtful accounts in chapter 12, we had a contra asset. It was an asset that goes up on the credit side. The same accounts for accumulated depreciation. It's also a contra asset. This is the first time together that we are hitting a contra equity or capital account. So contra stockholders equity account is what treasury stock is. So it belongs in the stockholders equity section of the balance sheet. It is deducted from total paid in capital and retained earnings, because basically what we're saying is we issued the stock, before, but now we're buying it back. So we have to show a subtraction from all our capital for the amount of treasury stock that we have actually bought back, because that amount of shares is no longer out in outside of the company, being held by people outside of the company. It's actually being held inside the company. So a contra stockholders equity account is an equity account, but it goes up on the debit side and down on the credit side. So it moves in the opposite direction to all our capital accounts, okay, but it still lives, it still hangs out in the same area with all the capital accounts. It just moves in a different direction. And when the company buys this treasury stock, they show the number of shares issued, in general outside, and also the number of shares that are being held in the treasury. The treasury is you're kind of saying inside the company. The company has its own area where, they call it the treasury, where they're holding the shares. Of course, in the days of everything being electronic, it's not like the shares are actually sitting somewhere at the company. There's just a record, an electronic record of the ownership. And let's say when we did an initial public offering, we issued 100,000 shares, and now we bought back 2,000 shares. So in the end, there's 98,000 shares that are outside of the company and 2,000 shares that are inside the company. Any questions on the theoretical discussion here? And if not, I'll just do one journal entry so you can see what it looks like. Shafak, do you still have a question for me? Sorry, I thought it was from before. Go ahead.
It was from before, but I just had a thought of one portion.
All right, go ahead.
So when these companies are pretty much in a loss, right? So they decide to buy back our stocks.
They don't
right.
have to be in a loss situation. They actually probably have too much cash that they don't know what to do with.
Okay.
Yeah.
I thought it's only for the rainy days.
No, they should actually be keeping cash for the rainy days. Like the example I gave with the airlines was they did not keep cash for the rainy days because they were too busy buying back their shares. And then when the rainy day came, they had to ask the government for money because they had already used up all their money to buy back shares.
Right, okay.
Yeah, no worries. See, what's up?
So the difference between what we did till now and what we did now is that before we had companies selling stocks and make money, but now they are buying stocks
And paying
and
money.
paying money.
Exactly,
That's the difference.
exactly,
Okay.
exactly. It's almost the opposite, right, of what we were doing before. They're not generating cash by issuing stock. They're spending cash by buying back the same stock that they issued previously.
Yeah,
Yes.
'cause I feel like the title doesn't like it sounds so much more complicated than it
Treasury
is.
stock, the name doesn't really convey much of what's happening, but unfortunately, it's a fairly common term that the kind of the inside of the company where all the financial stuff is being done is sometimes called the treasury. So the name is supposed to imply that the stock is being held internally by the company. But I agree that the name doesn't really tell you anything. They could almost have called it buyback stocks or something. Right?
Thank you.
Cool, no worries. Okay, so let us look at just the first part of this. I promise just the first part of this entry, just in case some people are feeling, very studious and they want to try and attempt something in the homework. And then, on when will I see you again? On Tuesday. So far away, right? Hopefully we wouldn't have forgotten everything. So on Tuesday, we can continue on because there's going to be, as there always is with accounting, exciting times, right? Fun times. There's the buying back of the treasury stock, which we'll go over now. But then there also comes a time when the company might decide to issue those stocks that they bought back. They might issue it into the public again. So thank you. So basically there's going to be two things going on. We're going to buy back the stock, and then in some of these questions later on, the company decides to reissue it. Because remember, these stocks were bought back, but they're not fully retired, so they can be issued again. So let's just look at what happens in example 12. On February the 1st, 2018, Mead Inc. acquires 4,000 shares of its stock. So already your mind, just like what C was saying, your mind needs to kind of flip here or be changed. Your mindset needs to change away from we're issuing stocks to receive cash, because we are acquiring means we are buying 4,000 shares of its. This is the giveaway, right? We're buying our own stock at $8 per share. $8 is the cost. And if you go back to what the textbook says or what our notes are saying over here, we use the cost method. So even if it had said that there was a $5 par value or $1 par value, you don't care. The entire transaction is recorded at the cost of the stock that was bought back. Prepare the journal entry required. So I'll show you over here how we do it. And then we'll be done for the day. So the debit goes to the contra stockholders equity account, treasury stock, okay? And the debit is the number of shares, which is 4,000 shares, times the cost per share, okay? In fact, sorry, I should have written out the word. So it's the number of shares times the cost per share. So it's going to be 4,000 times 8, which is 32,000. And then the credit, because we are paying, remember what Shafak asked, are the people actually getting money for those shares that they're giving up? Yes, they are. They are getting the 32,000 in cash. So again, treasury stock is not an asset. It's a contra stockholders equity account that increases on the debit side, and it will be shown as a subtraction from common stock and retained earnings, etc., in the balance sheet. In fact, I'll just go into the book here in a second and just show you how it gets subtracted. Okay, so this is the journal entry for the purchase of treasury stock, which is the same as a share. And in regular language, we call it a share buyback. Okay, I think this is hyphenated or something. A share buyback. That's the type of language you might see in the news or whatever. And then let me just go in here and see if I can show you. See, did you still have a question for me? Sorry, I see your hand is up now.
It's from back then.
I was from before, okay? So remember that same illustration 1311 that I was talking about? That is a good example of how this stuff works. There you can see that the treasury stock is a subtraction, right, from the paid in capital and retained earnings. In this case, the company had bought back 10,000 shares, which also means that if you look up at common stock, right, the company issued 400,000 shares once upon a time, but because they bought back 10,000 shares for the treasury, only 390,000 shares are still outstanding. And the word outstanding is talking about what's outside of the company, because the treasury stock is inside the company. All right, so treasury stock, a deduction on the balance sheet. All right, so let's end it there. There was something I wanted to show the people who were saying that they were pretty interested in oh yeah, go ahead. Who's talking?
Sorry, Professor. And can I see number 12? I wasn't.
Oh yeah, sure.
Thank you.
Yeah, no problem. There were a few people who last time when we were kind of talking just lightly about investing in stocks and so on, and I think it was Denise or someone was saying like, where do I begin and etc. And I just wanted to tell you that I don't know if you know this, but there is actually a class that's being offered at LaGuardia. It's called BTM 106. It's about personal finance and individual investing. It's taught by Professor Santo Trapani, who's also great at finance and such related items. And so that if you're ever interested in actually taking a course that is geared towards learning how to manage your finances and also investing. That's like a basic course that has been created. It's actually a course that mirrors basically the same course that is being offered at Baruch as part of the business administration program. So if you want to know more about that, I can speak to you offline, but I just wanted to say that there are actually course offerings at LaGuardia that form part of the program core for business administration. So it's not like you're taking an extra class that's not going to count towards graduation. It does. It's standing opposite another class, so you could do an either or situation. You can talk more to me about that because I can show you where it fits on the degree map. If you are so moved to take that course, it might be something that you would find useful. All right, so I see there's suddenly four questions. Yeah, BTM 106, sorry. I can also show it, yeah, sorry, 106. I'm going to show it. The people, if you need to go, you're welcome to go, but I'm just going to show you the degree map here quickly. So for those who are definitely interested, so the degree map for business administration, where am I? Yeah. So I'm talking about, oh, I got it wrong. Thank you. I'm glad I went in here. BTM 106 is the communication course. Sorry, Jefferson, I hope you're still on. BTM 105, financial planning and individual investing. Jefferson, are you still here? Oh boy. Okay, I'll send that.
Yes, I'm still
Oh,
here.
okay,
I'm still
okay.
here.
Sorry, it was 105, 105.
Okay,
My bad.
thank you.
I got confused. The 106 is also new. It's a business communications, but that's not the one that I was trying to talk about. So 105, you could take that class in lieu of doing, if you didn't want to take 201, the business internship, you can take the 105 financial planning and individual investing, where you can actually learn how to manage your own finances and how to begin to invest and create a stock portfolio for yourself. I can vouch for Professor Trapani, he's excellent. He and I were running the finance club together. So, you know, him teaching that course is great. So if anybody's interested in that, if you have not yet done the business internship, you could actually put this course as you know, an option where you do this course instead of the internship. Your choice.
So
Professor,
Sorry,
sorry,
go
go
ahead.